Hey guys, welcome back to the channel. Today was a day we'd probably all want to forget. Today just wasn't a red day in the market though. It was a warning for us investors. Because if you were watching closely like I was, you probably also felt there was something that just quite didn't make sense today. And here's the scenario. We're in one of the strongest technology cycles we've seen in years. AI demand is accelerating. Data center spending is exploding. It's off the charts. And semiconductor companies, let's just say memory companies, they're putting up numbers and earning prints that would have been unrealistic just a few years ago. And yet, today, the market sold, and it sold hard. It just wasn't one company, one sector. It was a broad, aggressive selling across tech, across semiconductors, across the very companies that are supposed to be leading this cycle right now. You can see on your screen, look at all that red today across the S&P 500. So the real question for me today was why were the stocks down? I think the real question to me was, what is the market starting to see that most investors haven't fully processed yet? Because today wasn't about one headline. It wasn't about one earnings report. It was about a shift in how the market is viewing or thinking about inflation, interest rates, and risk. And more importantly, it was a signal, a dangerous one for all of us investors to understand. The market is starting to price in something very uncomfortable. Not that growth is collapsing, because it's nowhere near that. Growth is off the charts. The market is starting to price in the fact that inflation could stay high enough to keep the Federal Reserve from cutting rates. And if that happens, the safety net that has supported this market for the past year may begin to disappear. And once we understand that fact, everything that happened today in the market becomes a lot clearer. It starts to make more sense. So in this video, we're going to talk about the factors that drove down the market today, what exactly they were, and what impact did those have on companies like the memory stocks that we value on this channel. If you haven't done it already, hit like, hit subscribe to the channel. Let's dive in and talk about the one macro headline, or the one macro force that I think is driving everything. Can you guys guess what it is? Drop it in the comment below if you can. But here you go. To me, it's the one factor that's driving everything right now is oil. Take a look on your screen. The Brent crude futures overall reached 112.19 today, up $3.54, 3.26%. Look at the graph. You can see the growth just in the one day, how it accelerated today. This is putting pressure and concern on everything. The VIX index, the volatility index, reached up over 27 again today. Fear and anxiety is entering back into this market. It's what we're dealing with Operation Epic Fury. We just continue to ebb and flow with fear and anxiety. We are in a headline-driven world right now, and it is causing havoc in the market. But overall, look at the one day, up 3.3, 5 day over 5%, 1 month over 66%. Guys, this is having a significant impact on the market. Over the past few weeks, oil prices have continued to move sharply higher, driven by the escalating geopolitical tensions and the headlines that we're seeing related to Operation Epic Fury. And it's continuing to cause concerns around supply disruption. This is no longer being treated as background noise by the market or by many investors. This situation has reached a point where investors are beginning to take it very seriously, partly because of the strategic importance of global energy routes and the potential for sustained supply constraints. You guys see, when oil prices rise quickly, the impact is immediate and widespread. You saw it on what I put up around the impact across the entire market today. It doesn't just affect gas prices. It flows through transportation costs, manufacturing inputs, and ultimately the price of goods across the economy. In other words, it feeds directly into inflation. And that's where the problem begins. For the better part of last year, the market has been operating under the very specific assumption that inflation will come down. The Federal Reserve will eventually ease policy, lower interest rates, and support higher valuations for the companies that we love in the tech sector overall, for high growth sectors like tech and high growth companies overall. But today, that assumption began to crack. Concerns began to rise in the market about will that reality happen. As oil moved higher Take a look at what happened with overall with the yields on treasuries. Take a look on the far right of your screen. The 10-year treasury yield reached, right now it's at 4.2. It's actually down since the market close. I saw it at market close at about 4.34. It's gone up significantly. And that is having an impact on the market too. When we see oil moving higher, bond yields follow. And when yields rise, like we're in a situation right now, the market begins to reprice everything. Investors start asking a different question. The question is no longer is when will Fed cut the rate? The question now is, will they cut the rate at all? And like I mentioned in a video the other day, if we continue to see inflation concerns, where we're going to ask ourselves now is not will they cut, but are they going to increase the rate to try to keep inflation under control? So that's the signal we're seeing in the market right now. It's not that the economy is collapsing, but that inflation could remain persistent enough to limit the Fed's flexibility. And if the Fed continues to be constrained, the entire framework supporting elevated valuations for companies that we love begin to shift. And so we see those shifts in tech particularly. Tech gets hit hard, and it's one of the first sectors to feel the impact of this overall. Because technology is fundamentally a duration trade. Investors are not just paying for what these companies earn today. They are paying for what these companies are expected to earn in future years. And when interest rates rise, those future earnings are discounted more aggressively, which lower the value investors are willing to assign to them today in the present. This is what we call multiple compression. And it can happen even when the underlying businesses are performing exceptionally well, like we see in today's market. When we look at memory companies, high-tech companies, these companies are performing exceptionally well with strong earnings, with demand, revenue visibility, but yet they're continuing to pull back and feel constrained. It's what we're seeing in today's market. Major technology and AI-related companies come under pressure, not because their growth outlook suddenly deteriorated, but because the macro noise or the macro environment has shifted against them. But there's also another layer that happened today that's adding more pressure to the technology sector. And that situation involves Supermicro. They introduced an element of uncertainty into the AI infrastructure trade. A company that has been closely tied to the build out of AI systems suddenly became associated with legal and regulatory risk tied to exports. That doesn't change the demand for AI, but it does introduce friction and uncertainty into the ecosystem. And in a market that is already adjusting to higher yields, shifting rate expectations, that kind of uncertainty can amplify selling. So what we had was a combination of macro pressure and emerging risk factors hitting one of the most crowded trades in the market today. And those factors drove down stocks big time. And we'll take a look at the impact that it had on memory stocks. Let's jump over and just take a look at how the memory stocks are performing, because it's good news, I would say, in some regards, that we're starting to see a rebound in the after hours. But as you can see on your screen, Micron took a hit today, right? Down $21. I mentioned in my video a couple days ago that after a print like this, it's typical to see a stock go down 3.5% to 5%. We're right in that range right now. But it was driven down by a few factors overall. I think the biggest issue was our investors and analysts are starting to think it had the best come yet for Micron. Is this the best that we'll see for this company overall? They're building out some supply, building out fabs, which is going to increase their inventory. Is that going to cause supply concerns in the market? I think when their CEO came on and did an interview after the earnings, he said, we don't see any let up in demand or pricing power that we'll have as a memory company to well into 2028. But there is concerns around that. That's having an impact on it. All the other factors are having an impact on not only Micron, but on all of the memory companies. If you look on your right, you could see SanDisk was down by $62 today, 8%. Western Digital was down by 7.5%. And a little further down, Seagate was down by 5.5%. The great news is they're all responding in the after hours right now. Micron is up. You can see on the left side, $4, $4.50. We see SanDisk is up over $10, climbing back to $7.20. Seagate is up over $5 to $5.17, and Western Digital is back up over $4 and $4.50 a share. So great news in the after hours. I'm going to drop a video tomorrow to talk about some very specific whale action that we saw at the end of the day today. Guys, there was massive, over $4 billion in trades that happened, probably $4.5 billion in trades that happened at today's close and in the after hours. Don't miss that video tomorrow. Make sure you turn on the notifications for my channel so you can see what exactly is happening in the dark pool with Micron after the action today and into the weekend. But overall, the environment we're in right now is hitting memory stocks. And Micron, they delivered, as we know, one of the most impressive earning reports in semiconductor industry. Revenue growth was explosive. Margins expanded significantly. Demand for high bandwidth memory remains incredibly strong. They're sold out through 2026. Now I'm hearing they're sold out through 2027 as well. And that's what investors wanted to see. The print that they had was outrageous. It was everything we wanted to see and more. Yet the stock fell. That disconnect is the signal, because the market is no longer debating whether the AI demand is real. That part of the story is widely accepted. The market now is debating sustainability. Micron's management made it clear that they are increasing their CapEx expenditures significantly, over $25 billion. That hurt the stock too. And the worries were that while that sounded positive, the market interpreted it differently. It sees future supply. And in memory, supply matters more than anything else. This is an industry that has historically been highly cyclical. I think that cyclicality has been broken. I've said it many times, but the market hasn't caught up to that yet. They continue to see that supply is tight, pricing is rising, margins expand. But when companies overbuild, their concern is that supply catches up, prices fall, and margins compress. So even though today's demand environment looks incredibly strong for Micron and the other memory companies, investors are already looking ahead and asking the question, what happens when new capacity comes online? This question alone was enough to create pressure on the stock today and in the last couple of days, especially in a market that is already dealing with macro uncertainty. Now, when Micron moves, we know they're the alpha. They are the biggest company in the space. So when they move, the rest of the memory stocks tend to follow. Western Digital and Seagate, which are more exposed to data storage, are actually benefiting from AI in a very real way, as you know. As AI workloads expand, the amount of data being created is exploding. The data needs to be stored, managed, and accessed. And that's where those companies come in and benefiting significantly. Structurally, they are in an extremely strong position, but today didn't reward that, because in a macro-driven sell-off, correlation takes over. Investors aren't carefully separating HBM from HDD or NAND. They are reducing exposure across the entire category. SanDisk is another example, they have more exposure to traditional NAND, and consumer-driven demand was hit even harder today. In periods of uncertainty, the market tends to sell what it perceives as more cyclical and less structurally advantaged. And when you step back and look at everything together, today's sell-off becomes much easier to understand. It wasn't a single event. It was a convergence of multiple factors, all pointing in the same direction. Rising oil prices fed inflation concerns. Higher inflation expectations pushed bond yields upward. Rising yields forced a reassessment of interest rate policy. And at the same time, an uncertainty within the AI ecosystem introduced additional risks into a crowded trade. All of this occurred in a market that had been positioned for continued strength. And when those conditions align, selling can accelerate quickly. And that's what you saw today. Not panic, but a broad and rapid repricing of risk. So what does this mean for us as investors as we move forward? Our focus shift now to what's next, because the market is no longer trading primarily on earnings. It's trading on macro signals. And those signals are changing quickly. They're changing day to day. We know that. Going into next week, the most important variable continues to be oil. If oil prices continue to move higher, the pressure on inflation expectations will remain, and that will keep bond yields elevated. That environment is not supportive for high growth, high multiple stocks. At the same time, yields themselves become a key indicator. If they stabilize or move lower, that could provide some relief and allow tech to recover. If they continue higher, the pressure on valuations will persist. And that's where we introduce the wild card, which is the headlines that we live in. This is a headline-driven market right now overall, and it's being fed by the headlines and adjusting risk accordingly. Developments over the weekend could shift sentiment dramatically in either direction. De-escalation could bring buyers back quickly. Escalation, and what we're seeing in Operation Epic Fury right now, could push the market into a deeper correction. For memory space specifically, the question is whether investors begin to separate structural AI demand from traditional cyclical concerns, or whether everything continues to trade together in the short term. So here's the reality for me. The AI story hasn't broken. The demand is there and demand is huge. The growth is there and it is massive. The long-term opportunity remains incredibly strong, but the environment around it is changing. And right now, the market is trying to answer a very important question. Can strong fundamentals overcome macro pressure? Or does macro pressure win in the short term? Because today wasn't random. It was a market adjusting to a new reality, a reality where inflation may not fall as quickly as expected, where interest rates may stay higher for longer, and where the Federal Reserve may not be able to step in as easily as investors had assumed. And that is a dangerous signal, because if the Fed is constrained, safety net disappears. And when that happens, markets just don't move, they reprice. Because today wasn't the end of anything. It was the market telling us all something. It was telling us that something has changed and we need to pay attention. Take care, guys. I hope you enjoyed the video. See you in the next one.